Hello, I'm Julian Whittle, Business Engagement Manager with Cumbria Chamber of Commerce, and I'm here with Kathryn Brown, Corporation Tax Manager with Dodd & Co Chartered Accountants. Kathryn is a qualified tax advisor who works with owner-managed businesses, and we're going to talk about the tax treatment of company cars and pool cars. Now, this can be a bit of a minefield, can't it, Kathryn?
Yes, absolutely. Now, providing company cars to employees sounds like it should be pretty straightforward, but it's actually a rather complicated area from a tax perspective, and it can be pitted with lots of minefields. Because of that, it's actually very easy for the revenue to find problems with company cars if they come looking, and that can lead to some quite nastily high tax bills.
Now, when a business gives an employee a company car, the employee pays a tax on the benefit in kind, don't they? So far, so good. So what can go wrong?
Well, that's the idea, but the car benefit charge is based on a formula, and that formula depends on the CO2 emissions of the car and its list price. Get that wrong, and that's where the benefit in kind charge and calculation goes wrong, and that's what leads to under-declarations of tax. One common mistake in applying this formula is that employers sometimes use the cost of the car to calculate the benefit in kind charge, and that can be an error that's done in genuinely good faith. But what the legislation says is that it has to be the list price that's used, not the actual cost to the company, and there's no wriggle room on that. So I have, for example, seen a true case where an employer has provided an old, rickety, run-down and quite frankly not very nice car to an employee to use it as a runabout, and let's say that car cost the company just a couple of grand. They've then declared the benefit in kind on that couple of grand, and they've thought that that's the end of the matter. However, the revenue have then picked up on this, and we find that the list price of the car when new was much closer to around about £30,000, and the revenue have assessed the benefit in kind charge on the £30,000, not the couple of grand that it cost the company. So you can see that there was a big difference in tax, and a lot of tax that was under-declared there by a genuine mistake. So you can see that the tax cost there is completely out of proportion to the fact that a nasty little car's been provided.
Yeah, so it's the list price of the car when new, regardless of how old it was when the company acquired it as a company car.
Exactly, and that doesn't sound fair, but that's how it is.
Yeah, well, that's really quite interesting. And what's the other pitfall is to do with fuel, is that right?
Yep, absolutely. So what you've got another benefit in kind charge arises if private fuel is provided for that company car as well. Now that is worked out slightly differently, still on a formula, but it uses a scale rate charge and again times by the CO2 emissions of the car. And the scale rate is getting ever higher, so it's very expensive to provide private fuel. And what can happen often is that the employer accidentally provides private fuel. Now it sounds a bit silly to say accidentally, but again this is a mistake in good faith. So it can easily happen, for example, where a fuel card is used. So all of the fuel is paid for, and then the employee is supposed to reimburse the private fuel that he actually uses.
Yeah.
But if, for example, the employee doesn't keep very good mileage records, or if he uses the wrong reimbursement rate to make his calculations of what to repay, then technically private fuel has not been reimbursed and it has been provided. And again, this is a very lucrative area for the revenue because it's such an easy mistake to make. And the costs on private fuel can really be very scary. If the shortfall of the reimbursement is even just a couple of quid, the full fuel benefit and charge rate is applied, and again there's no wriggle room on that, and it seems again very unfair, but that's where some really big tax liabilities can kick in.
So let's be clear, even if there was an error of just a few pounds in incorrectly claiming back the private mileage,
yes,
there could be a tax liability of perhaps thousands of pounds.
Absolutely, thousands of pounds. It just doesn't make sense and it doesn't seem fair.
And who pays that tax liability? Is it the employer or the employee?
Well, that's an interesting question because technically the liability is, of course, that of the employee. They're the one who's been provided with the benefit. But it's the employer who's got the responsibility for filling in the P11D forms, which are the forms on which the benefit in kind is declared. So what the revenue will do is they will come after the employer in the first place when they found underdeclared tax of this nature, and they'll ask the employer if they will voluntarily make good the tax on behalf of the employee. And to be honest, honest with you, most employers say yes, because it's very difficult, I think, to pass on that cost to an employee, whether it's been a genuine error in good faith. Now, interestingly, this makes the tax bill even higher because, I know I laugh, it's not funny really, but if the employer pays a liability on behalf of the employee, that itself is a benefit in kind, and therefore more tax is due, which the employer also settles on behalf of the employee. So it can lead to phenomenally high tax bills for fairly innocuous mistakes.
So it's a case of make sure you get it right first time, isn't it?
I'm afraid it is, yeah.
Now let's move on a little bit. What's the difference between a company car and a pool car?
Okay, so a company car is one that is provided to an individual, and it may or may not have private use. The scenario we've been talking about, it has been available for private use, and that's where the benefit in kind charge comes in. But a pool car is different. It is not provided to any one employee. It is made available to a number of employees, and it has a number of conditions attached, one of which is that there is no private use. So it's a different beast altogether.
But a pool car's more attractive from a tax perspective, isn't it? So what criteria does a business have to meet for a car to be classed by HMRC as a pool car?
Okay, so the legislation is very clear on this. There are 5 conditions. The first one is that the car has to be made available to and used by more than one employee. Okay, that's fine and reasonable. The second one is that the car's got to be made available because of the person's employment, rather than, for example, as a personal favour or something like that. And that one's not normally a problem. The third one is that the car is not ordinarily used to the exclusion of others by just one person. Now, this has been put in to stop people trying to be clever, quite frankly. So it won't work if a car is given to, let's say, one individual to use for most of the year, but then a couple of other people are allowed to borrow that car. That does not make it a pool car. It would fall foul of that condition. The fourth criteria is that any private use of the car is incidental. So it doesn't say that you can't have any private use, but it's really got to be very periphery to what the car is actually being used for business purposes. And the last one is that the car is not normally kept overnight at the residence of any of the employees.
And to be clear, all these conditions have to be met. It's not any one from 5, it's all 5.
Exactly. So if one fails, it's not a pool car.
Right. So if an employee, you raise this as the 5th condition, I think. So what happens if an employee takes a car home at night to enable them to go straight to a business appointment the following morning? Is that allowed?
Yeah, well, this actually, you would think that it breaches both conditions 4 and 5, but the Revenue have been a little bit helpful on this, and they've acknowledged in their guidance that this is a real life situation which does often happen. So they have set out some guidance to say this scenario would be okay, even though taking it home is technically private use and it's being kept overnight. But don't think that's a complete get out of jail card. They have warned that somebody can't expect to do this very often. It really should be just a very one-off occurrence. If it happens too often, they'll say it breaches the condition and it's not a pool car.
Okay. Now, what records should employers keep to back up their case in case HM Revenue and Customs comes calling and challenges whether a vehicle is actually a pool car?
Yep, absolutely. Very, very important question. So what the employer would be looking for is any evidence, anything at all which demonstrates that the car is available to a number of different employees and not particularly to any one person. So a booking out system would probably be a really good idea, say with an administrator who keeps charge of the keys and has a diary where individuals log out the use of the car and then log the use back in as well. That demonstrates it's not just a free-for-all, and then you can prove who has had use of it. A written policy setting out what use is permitted would also be a good idea, but along with that is also how do you prove that? So a monitoring system would really be needed, either detailed mileage logs or even better a tracker fitted to the car so that at any point in time somebody can go in and look and see where that car's been and can make sure that people haven't been taking it home, that it hasn't been going to the shops, that it has just been used for business journeys. So what you're looking for is anything to evidence this so that it's not just an argument between the employer and HMRC, which is always going to end in tears.
Thanks, Kathryn. You've demystified a complex subject there. Before we go, there are a few tax changes pending regarding cars that are worth flagging up. First of all, diesel company cars are being hit by a tax change, aren't they?
Yes, so this change is coming in from April, which is just a few months away. And as I explained earlier, what happens with a company car benefit is that it's based on a formula, which is CO2 emissions and list price. But that formula also comes with a surcharge for diesel cars. It's like a penalty, and there's basically an extra 3% charge on top of that benefit in kind charge if your car's a diesel. Now, from April, that 3% surcharge is going up to 4%, so it's going to make the provision of diesel cars even more expensive. Now, this came as a bit of a surprise. We weren't really expecting it, and we haven't been given very much notice, which seems a little unfair to diesel drivers who didn't have this information last year, maybe when they made their choice about what kind of car to take. But the government was under a lot of pressure to do something about clean air and pollution, and I'm afraid that diesel cars are just an obvious target.
But there's better news on electric vehicles, isn't there?
Yeah, so this is just a very small change, but it's a welcome clarification just so there's no misunderstanding. And all it says is that if an employer provides electricity for an employee to charge their electric car at work, there is no benefit in kind. We didn't really think that there was, but now they've come out and written it down, and that's great.
Okay. And there's something happening to the car fuel benefit charge and the van and fuel benefit charge.
This is simply that the formula that I mentioned and the scale rates that I've previously mentioned are all going up in line with inflation. So everything's going up by RPI, and I'm afraid it just means that company cars and company fuel gets ever more expensive.
C'est la vie. Brilliant. Thanks for your time, Kathryn.
Thank you.